Hello, everybody, and welcome to NewRiver's first ever podcast. I'm Allan Lockhart. I'm CEO. By way of background, NewRiver is one of the UK's leading retail real estate REITs. We have a nationwide portfolio of nearly £600 million, comprising shopping centres and retail parks. Our assets serve millions of customers every year, and our portfolio in particular is focused on essential goods and services. In addition to that, NewRiver has a highly successful capital partnership business where we manage assets on behalf of our partners, including Bravo, private equity firm, M&G, and Canterbury City Council. In total, we're managing on behalf of our partners a portfolio well in excess of £500 million. So combined, we have an incredible insight as to what's happening in the retail real estate sector. But today, I'm joined by Dr. Clive Black. I would say Clive is probably the number one consumer and retail analyst in the public equity markets. He's very smart. He speaks the truth. In addition, Clive was very instrumental in Shore Capital securing two very high-profile brokerages, M&S and indeed Sainsbury's. And prior to the appointment of Sainsbury's, Clive's firm were involved in the very successful sale of Morrisons. So welcome, Clive, to our first ever podcast. So I thought I would start with the economy, interest rates, inflation. I think I'm right in saying that you joined our board meeting maybe back in January 2022. And at the time, the Bank of England was telling everybody that inflation was going to be transitory. And indeed, many people in the equity capital markets and analysts were following that view. But you had a different view at that time, which obviously gave us a great sort of insight. But anyway, what is your thoughts today around the economy and inflation and interest rates?
Well, look, it's a great pleasure and privilege to be your first video guest, Alan. And look, the turn of 2022 was a very difficult period, as were the year or so before that with the pandemic. And of course, not long into 2022, we have the disastrous invasion of Ukraine. But that word transitory is really important. And I think the legacy of transitory is with us today. We had a conversation with the governor of the Bank of England in Manchester in mid-21. And industrialists around the table, retailers, people who run technology businesses were really unscratching their head as to how he thought inflation was transitory. And the antecedents of the present inflation have been really well set. Quantitative easing, keeping interest rates far too low, set against a labour market that is just structurally tight. That is not the stuff of transitory inflation. And so if we go full circle, we were a lone voice at that time in front of your board. And today we've got inflation coming down to just under 8%. It peaked at 11%. We have interest rates going from 0.1 to 5%. And we've got wage awards of 6 to 8% at the moment. So the term crisis, which we may come back to in our conversation, is massively overused. Cost of living crisis, we hear it everywhere. It's become an idealistic and political word. At the moment, living standards are falling. And last autumn, they were falling at a really rapid pace. Interestingly enough, we think living standards, will be rising come the new year.
Yeah.
So inflation is set to fall this year. We think it'll be around CPI around 5% at Christmas. We also think that wages and salaries will be growing around 6 or 7% then. So I wonder if people are going to replace the word crisis with euphoria in the new year when living standards actually rise. But inflation is the key economic number of our time.
Yeah.
And until it's controlled, it is going to dominate everything. From our perspective, as I say, we expect inflation to moderate but still be with us. Inflation is here for longer. Higher interest rates are here for longer. They may peak at, as I say, 5.5%, 6%. I would have thought this time next year there'll be not much less than 4%. So that is a really changed dynamic since the time of 2008 and the start of the great financial crisis.
Now, NewRiver's been a lot more insulated. We don't have any debt maturity until 2028. All of our debt is fixed at a 3.5% coupon, which puts us in an incredible position. But as a management team and a board, we recognize that there were elevated risks last year, as we still believe that we're in a market with elevated risk. So we have been deliberately focusing on maintaining the strength and optionality of our balance sheet, and that's definitely been the right thing to do. And I think notwithstanding that the listed real estate sector has been really impacted over the last 12 to 15 months in terms of share price movement, total shareholder return, we've actually outperformed the market. We've been one of the number one company or one of the top companies in terms of share price performance and total shareholder return performance. And I think that's just reflective just of the strength of the balance sheet and the key decisions that we have made over the last sort of 2 to 3 years to ensure that we were well positioned in this sort of environment.
I mean, I know it's a technical acronym for the real estate industry, but your LTV, you positioned yourself really well for not just the pandemic and Ukraine war, but you couldn't predict. But you actually did position yourself very well in terms of where you stand on LTV, and you still are fantastically positioned in that respect, aren't you?
I think that's the case, yes. I mean, our LTV is now one of the lowest in the sector, around 30%. We have one of the lowest net debt to EBITDA ratios, one of the highest interest cover ratios, and our portfolio yield to our cost of debt, the spread, we have one of the highest spread in the listed real estate sector. So the balance sheet is in a great place, but that's not happened by accident. That has happened by the strategic decisions that we as a management team and a board have made. We have sold well over 300 million of assets over the last 3 years, which has allowed us to pay down our debt and lower our net debt position. And, that's been the right thing to do. And that's why we believe that today, we've been far more insulated in terms of the sort of rapid increase in interest rates. And we put ourselves in a position where we can really grow from here because we have a lot of optionality.
If we go back to that January 2022 board meeting, if you took the other view that everything's honky-dory, that inflation wasn't going to materially rise, interest rates weren't going to go up, and you deployed capital at the time, allowed your LTV maybe to go back to your historic ambition of 40%.
Yeah.
I mean, cataclysmic.
Yes, I agree. And obviously nobody knows the future. Predicting the future is always incredibly challenging. But, it's very important to be analysing sort of current environment conditions and, listening to experts like you, Clive, who were advocating that inflation was going to rise rapidly and therefore monetary policy would have to respond to that through a significant increase in interest rates. But talking about interest rates, let's bring it back now to the consumer, because we've been arguing, well, we were certainly arguing 12 to 15 months ago that the UK consumer was going to be more resilient than the financial markets were expecting. And arriving at that sort of conclusion, we were taking account of the fact that consumers have very elevated savings. Unemployment is at a record low. There are a lot of job vacancies. So if you want a job, you can generally get a job. House prices up to now have certainly been stable, and we've seen, quite significant growth in house prices over the last, 3 to 4 years. And so taking all of that into account, retail sales and spending has been actually pretty resilient. But what's your sort of take around the UK consumer today and the prospects over the next sort of 12 months to 24 months?
A little bit worrying. It sounds like you've read some of our notes. You characterise the moving parts well. I mean, I said earlier on the term crisis is overused. Inflation is very regressive for poor households. And I really feel sorry for, those households, mum and dad, 2 or 3 kids, living on low income or benefits. There's no doubt that, rocketing gas bill, rocketing food prices, they really limit their scope for discretionary spend. But generalizations, I think, are quite dangerous when it comes to the consumer economy. So if we take a few of the moving parts, the first thing is the pandemic period saw the government pump an unprecedented amount of money into people's bank accounts. Full stop. And it's one of the reasons I balk at the term crisis. A lot of people got the memory of a gnat when it comes to that actual change. Also, particularly we're sitting in London today in the home counties, a lot of professional people have been working in their back gardens for the last 2 years, saving enormous commuting bills. So if we look at the professional classes, the older element of Britain's consumer economy, those people who've paid off their mortgages, 500,000 people pay off their mortgages a year.
Yeah.
Those folks on final salary pensions, do you remember them?
Yeah.
With rising interest rates, they're actually got more money.
Yeah.
So there's a proportion of the economy that's flush. And we see that in not necessarily so much your arena, Alan, but in the consumer leisure sector. The holiday trade is booming. And what we can see in terms of family priorities is that the family holiday is the number one priority. And so record numbers of people travelling abroad on holiday this year. I mean, that's not a sign of a crisis economy, let's be clear. The second thing I would point out is employment, and that's probably the most fundamental. Unemployment at under 4%, as you said, more than 1 million vacancies. Yeah. And, I said earlier on, we're looking at 6 to 8% wage growth with inflation falling, rising living standards. So that's a much brighter outlook for the consumer. And most critically, if employment remains fulsome, the housing market will remain firm. Again, I look at headlines in the newspapers, housing crisis in terms of prices. In the year to August 22, house prices went up 20%.
I agree. And a lot of consumers' net worth is tied up in the value of their house. And I know there's a lot of concern around mortgage rates currently today, but I think the case is that about 25 to 30% of households are mortgage free. I think it's only about 10% of households actually have a mortgage rate maturity this year. So it's much more nuanced in terms of the impact of rising interest rates on mortgage rates. But coming back to the sort of the consumer, we can see how that's sort of feeding into retail sales, because the value of retail sales has risen significantly over the last 12 to 18 months. Now, clearly, inflation is a major factor in there, but the other key indicator is the volume.
Yeah.
And volume has sort of got back to pre-pandemic levels, isn't it? Which is an indicator that the consumers are maintaining the sort of spending in retail, which obviously is really important for a retail real estate company like ourselves, because we're very dependent on our customers coming into our assets often twice a week to spend their weekly household budget in the tenants that we have within our portfolio. So, that's from our perspective being very, very encouraging. And in the retail market, it does feel like, the retail sector today is probably in its best position that it's been for quite a number of years.
I think that's right. I mean, there will always be winners and losers in retail. Let's be clear about that. But in terms of where the consumer economy is today, we are reasonably relaxed about the outlook. Just to underscore, the employment market is very important because that keeps the housing market stable. That also supports consumer confidence. So to your point, there was an understandable adjustment when inflation rocketed. Consumer confidence sunk. We then had Truss and Kwarteng, which kind of underscored it. And it's taken a while for people to regroup. But if we look at non-discretionary retail, groceries, we are seeing volume stabilize and starting to slightly rise now. Yes, there's been trading down. Yes, there's been a switch into the discount and bargain stores, but you're very well represented. But overall, we think we're through the worst on the grocery front. If we look at the sort of mass market for non-food. Again, retail sales data is stabilising. We, as you said earlier on, Alan, we have brokers to Marks and Spencers. We put a 6% upgrade through on them today. Next has upgraded through the spring. That's not crisis territory. It's far from it. Where we would be most worried, because I think it is important to be balanced, big ticket discretionary, which is associated with borrowing. So cars, bathrooms, bedrooms, furniture. DFS recently talked about the furnishing market being down 15 to 20%. That is tougher, but it's understandable when interest rates are rocketed and the consumer's just a bit. But this is where the generalizations become more problematic, because at the higher end, those households, as I say, often older, final salary pensions own their own place and all the rest of it. They're not looking over their shoulder on cost of living crisis, and they are spending. So, no, the outlook is improving. There are bumps in the road. Over the next 12 to 24 months, left field excluded, I think we should see a progressive improvement.
I mean, I'm constantly out visiting our assets and wandering around retail units and also meeting. I think a couple of weeks ago I was in Marks and Spencer's head office meeting the property director, talking about new opportunities within our portfolio for Marks and Spencer's. And there's no doubt as a business, they're very confident around what they've achieved and the outlook for them. But equally, as you rightly say, Clive, we have a lot of discount operators in our portfolio, and indeed one of my sort of favourite shops is Home Bargains in Birkenhead.
Amazing.
It's incredible when you go in there, just the range of products, and the prices are absolutely fabulous, and that's why we're seeing discount retailing, growing in the UK, increasing their market share and providing genuine value for money for people that are on low incomes.
And not so low.
But let's just talk about the retailers themselves, because I sort of think there's a disconnect with what's going on in the market versus what the real estate capital markets think. There's been such a massive focus around online retailing over a number of years, and many people in the sort of public equity markets and indeed real estate markets think that everything is going online and the physical store future is almost non-existent. And of course, when the pandemic came along and physical stores were made to shut by the government, it was natural that the online penetration rose rapidly. And I do remember reading and hearing people saying that is going to be an absolute permanent shift. But subsequent to that, we've seen a receding level of sort of online. But how do you sort of view the retail market, how it operates, online, physical stores, and of course, omni-channel?
Look, we nearly a generation now, nearly 25 years into the arrival of the internet, and then there is no doubt that it's it has been a structural and seismic change for the retail sector. And from a British perspective, we should be actually very proud, because the UK is at the forefront of online retailing. We have wonderful entrepreneurs who have grasped the opportunity of online. And we've also sort of got behemoths like Amazon, which has probably done more to kill small family retail businesses than any other one, out there, with very little government resistance. You make time-wise, you make a good point around pre-pandemic. Amazingly, I went to the Café Royal in 1987 to see Tim Mason, who was the genius that came up with Clubcard, announce that Tesco was going to start an online grocery business. And it took 23 years to go for the industry to go from 0 to 7% participation. So just before the pandemic, 7% of the groceries in the UK were bought online. It took 23 weeks to go to 15% in the pandemic. I mean, incredible change.
But they did that by leveraging off their stores.
They did that by...
I don't believe they added one extra square foot of distribution space. So it sort of demonstrates, and I think this is where maybe the real estate markets don't understand this, is that physical stores are so important in that online fulfillment.
Absolutely.
So if you take Marks and Spencer's, for example, who are a major omni-channel retailer and trying to grow their online, well, they're giving customers choice.
Exactly.
Customers want to shop in store or shop online, but it's all interconnected. I think it's the case that 60% of M&S's online orders are picked up in stores, right? 85% of returns go back to store. So really demonstrates the physical stores vital. And I would arguably say that stores are the genuine last mile distribution network.
Totally. So just to flesh that out maybe for you, sticking with grocery for a moment, you're spot on. Ocado, which is a dedicated online grocer, lost huge market share in the pandemic because it did not have the flexibility that Tesco and Sainsbury's had. That's a really important point to make. The second point is around the economics of fulfillment. So, Marks and Spencer next. Let's take them as an example. If you look at the pandemic, 65% of non-food trade was online. It's come down to about 35% now. That's an enormous shift backwards. And the economics of online retail, that click and collect, that fulfillment and using a store is so fundamental. And the warnings and the deratings we've had in retail since the end of 2020 have come from online, pure play. Pure play with the associated derating with inflation interest rates has been found to be vulnerable. And indeed, investment banking and stockbroking are full of people who talk their own book. But the absolute stratospheric nonsense that people like Ocado and the Hook Group, Made.com, and all these specialist pure plays talk in their book about we're all going to sit on our backsides, do everything online, was just nonsense. It was abject nonsense, but amazingly, elements of the market backed them. Pandemic normalization. How many mums and daughters, go out and buy shoes because they need shoes? A lot of households have got more shoes to, foot Blackburn. They go out and buy shoes because they enjoy buying shoes. Shoes is tactile. Retail is not just a functional aspect. And so your point, there's a lot of questions in your point, but stores are absolutely part of the future of retail as an experience, as a function, but most critically, has been central to online retail.
Yeah, I think in terms of online retailing, I think the majority of sales generated online flow through omni-channel retailers, because I think the ONS numbers suggest that the value of pure play online retail sales is around 14%, and the volume is similar. So that indicates that omni-channel retailers have the majority, and in many ways they can leverage off their portfolio. I think it's the case that the probability of a person going into a shop to buy just a loaf of bread and then coming out with just a loaf of bread is probably about 1 billion to 1. It's that incremental sales that you can get when you have people inside your store and customers coming to pick up. There's a high probability for incremental sales. And when customers are returning products, there's a high probability of incremental sales. And of course, you can reduce costs, the costs of delivering to home and returns. We're seeing many of the omni-channel retailers that are in our portfolio, particularly in our retail part portfolio, are now incentivizing their customers to use the store as part of that online fulfillment, which is one of the reasons why I would say 10 years ago, we started to invest in retail parks because we felt that it was so compatible with online fulfillment, very accessible. All the car parking is free, all at surface level. The unit sizes are large, which allows the operators to be able to run click and collect operations as well as the normal merchandising operation that they have. And we see that area of the market, growing.
And in terms of your insight and actual management of your assets, that's that multi-channel activity, click and collect car parking and facilities around that automated basis, even things, if you're moving on slightly into a different arena, things like quick service restaurants on car parks of retail parks. I mean, how has your thinking evolved around actually owning and running an asset like that?
Yeah, I mean, I think for retail parks, we do view them as being very compatible with online. We're seeing very, very strong demand for space. I think the vacancy rate in our retail park portfolio is about 2%. So it's, the supply side is super tight. We're seeing strong demand. It's very popular with our customers. So we're very much focused on ensuring that the tenant mix is aligned with what customers want. So, we're very much seeing good demand from omni-channel retailers, but equally we're developing interesting initiatives. For example, in our retail park in Dumfries, we facilitated a Next click and collect pod.
Mm-hmm.
And that's just there for Next customers to be able to pick up orders and return orders. It sits in the car park. It generates significant footfall. We get a small income stream from that. But it demonstrates how important it is for Next, where they can't get a physical store. They've been developing out those things. We're doing a stack of deals with drive-throughs. Very, very popular. Again, those are hugely compatible with retail parks. So a lot of activity from Burger King to McDonald's to drive-through Greg's, coffee shops, etc., which is great because you're adding an additional service for our customers.
It takes you into the food to go arena as well, doesn't it?
Exactly. But we're also seeing active demand from leisure operators, both in our shopping centre portfolio, but also our retail parks. So gym operators, are active and expanding, and that's reflective, I think, a greater focus of customers on their health and well-being. That's a key sort of trend going forward. But equally, also there's new leisure opportunities coming through. So, for example, we're in advanced discussions with a multi-leisure operator for our shopping centre in Cardiff to take over 100,000 square feet. And within that facility, you will have indoor go-karting, electric track, 10-pin bowling, cinema, karaoke, wall climbing, a whole range of things, plus F&B. And that's hugely popular with what customers and people are looking for today.
Given the performance of the Welsh rugby team, that's probably going to be a good attraction.
I think so. So I think, we feel very encouraged just with the level of occupational demand we're seeing. That's translating into our highest occupancy across our portfolio for 5 years now. So our occupancy is at 97%. We have a really high retention rate, and that's really important. And when I talk about retention rate, I'm talking about when our tenant comes up to lease expiry or when they have an option to break the lease. Well over 90% of our tenants remain within our assets, and that's a strong indicator that they're trading profitably. And perhaps more importantly of all, our portfolio has returned to rental growth, and that's probably the first time we can say that for 5 years, probably 2018. Now, I think this sort of reflects back to my comment around, we think that the retail market is probably in its better shape for quite a number of years. It'd be interesting to get your comments on this, but we've seen a very significant reduction in tenant administrations and CVA. So a lot of that excess competition capacity has been removed from the market. Obviously, business rates reduction is incredibly helpful. In our own portfolio, I think on average is about a 16% reduction straight on to the bottom line for our tenants. So that's helpful and supported. So it's a market that is in a better place than it has been for quite some time, which gives us a lot of encouragement going forward.
But to be fair to you, Alan, we talked earlier on about in early 22, you took decisions that were wise around capital allocation, but much longer you've took good decisions around who your tenants should be, around non-discretionary, around where people are going to gather, around lifestyle development. There has been failures in retail, and as I said before, there will be more. But you do have a client list that, to my mind, is going to be there, quite a while.
Yeah, I mean, we focused on tenants, operators, where a physical store is absolutely vital to their business and their future growth prospects. So, for example, the discounters, both in terms of the food discounters and the non-food discounters like, the Home Bargains, B&M, Primark. It broadly doesn't make any economic sense for them to transact online, given that their average transaction values are quite low. It would be very damaging for margins. So there are a whole bunch of retail operators. Physical stores are really important. That's why we're seeing that active demand, for space. Equally on the omni-channel side, what we're really seeing there is the big omni-channel retailers are maintaining broadly the amount of selling space, but they're looking to reposition to get into better quality space that is more compatible with their online channels. That's partly why we're seeing strong demand within our retail parks from omni-channel retailers. So we're really trying to focus on those two areas, supplemented by leisure, F&B, particularly drive-throughs and grab-and-go food, and other sort of associated services. So, really concentrating on your tenant mix, creating the right environment for your consumers will lead to, high frequency of visits and increase in dwell times. And the data clearly shows, that longer dwell times usually leads into higher spending, which is really, encouraging.
Quite interesting. You bring together some of the themes we've touched on. In, again, March 2020, Primark had to close all of its stores.
Yeah.
It had no online capability. And George Weston, who's more involved in his business than most chief executives, castigated. But he said very clearly, we're not going to run an online business to lose money. And here we are 3 years later, Primark stores gaining market share. Profit warnings have come from the pure plays.
Yeah.
And they've got the luxury to look at click and collect.
Yeah.
And also, interestingly, I thought one of the most, I don't know if it's a good or bad thing, but, the 3-4 mile queues for McDonald's when they were allowed to reopen in July 2020 told us a lot about people and how they behave and what they enjoy doing.
I love McDonald's. I have to be very, very disciplined in terms of my attraction to McDonald's. But
go back to some you talked about rental growth there.
Yeah.
Do you think? I know there's lots of things, lots of moving parts, and none of us are Mystic Meg, as we talked about for a long time. But do you think there's scope that your NAV could stabilize and actually rise over the next 2 or 3 years?
If you look at the key components on our property valuation, one is your income, your estimated rental value, and the other is the yield component. When we look at the estimated rental value component, we're really encouraged because, at the end of the day, real estate is about supply and demand. And supply in our portfolio is really tight. We've seen increasing demand come through. And our portfolio has returned to some modest rental growth. So we feel that the prospects with those dynamics are actually encouraging to start to deliver some rental growth. When it comes to the sort of yield component, as it stands at the moment, our portfolio is valued off a very attractive yield. I mean, I think we're over 8%. We're seeing increasing amounts of liquidity coming into the market. And retail has been much more sort of insulated in terms of the rising increase in interest rates because to some degree it's already had a lot of valuation rebasing that's already taken place. So it's at a point in the market where it's already offering a sufficient sort of risk premium, even over the sort of 10-year gilt. And our portfolio yield is higher than the sort of normal yield. So I feel a combination of that plus the increased liquidity that's coming into the market leads us to conclude that we think that the signs for our NAV are quite encouraging in terms of delivering a positive NAV print over the next sort of 12 to 18 months.
If we looked at the supply side around that, I'm presuming very few new retail parks are going to be built in the United Kingdom.
Oh, there's almost non-existent new supply coming through. I mean, as the market as a whole, there is still an oversupply, but the market's readjusting to that. So excess retail is being redeveloped for residential, and we have a part of our portfolio. We're looking to capitalize on that opportunity by redeveloping excess retail space for residential. And I think in total, we're working on something like 1,500 residential units across 3 projects at the moment. We're never going to build those out ourselves, but we can get planning, and then we can either sell it to specialists or bring in partners. But we're also seeing, leisure taking over former retail space. So I think the supply-demand dynamic is moving in the right direction. And when you clearly have demand exceeding supply, it's going to lead
absolutely
rental growth. And we're starting to see those signs now come through, which I think is very encouraging.
And across the market, I guess it's most apposite to shopping centres. But that point you made about residential, retail to residential, are you seeing local authorities, investors, institutional investors, starting to think about this in a more, I guess, significant material way? Because if we're not going to get any new capacity on retail parks in a retail sector where we think value and volume is going to grow on a sequential basis in the medium term, and if capacity is going to come out for alternative uses around virtually every town centre in the UK, what's your thoughts around that? Are you seeing that sort of interest, rather being the necessity?
Yeah, we are. We have our own core shopping centre portfolio, which comprises about 11 assets, and those are 11 assets located in different parts of the UK. Our core shopping centre portfolio is performing incredibly well. Our occupancy is sort of 97, 98%, retention rate well into the 90s. And we think those are going to be long-term, high-quality, sustainable shopping centres that are going to deliver very attractive returns going forward. But in the wider market, there is still an oversupply of space. We're seeing local authorities being recognizing that doing nothing is not a credible option. That there is a great opportunity to reinvigorate their town centres through the redevelopment or surplus retail to provide home living in town centres and city centres, but also cultural uses and educational uses and health uses. So real variety. So I think there's a real keenness and willingness from local authorities to support that. Clearly there are constraints around the planning system. It's been underfunded, and retention of people within planning departments has not been great. But also we're seeing more capital that is looking to get involved in those type of opportunities around switching from retail to residential. And that's a range of capital from house builders to investors that are interested in residential products, where you see more institutions thinking about social impact investing. So the capital is starting to move towards this. The opportunities are really clear and are there. And we're seeing more support and understanding coming through from local authorities. So I fully expect over the next sort of 10 to 15 years, the sort of current oversupply in the market will come down, and we will move into a market where you've got a much better balance between supply and demand.
And NewRiver's involvement in that, you mentioned you've 1,500 odd residentials in your work stream already. Do you expect to be more involved in that, or?
Yeah, I think we would certainly do it in the right way. We've got a lot of capability and skill set, but we will not seek to expose our balance sheet in a significant way. So if there's an opportunity for us to apply our skill set and capability in a very capital-light way, then that's something that would be very appealing to us, particularly if we are to receive, fee income in return for the quality of services that we can provide, and we can work with partners both in the private sector but also in the public sector. That we do see that as an opportunity for us going forward.
And I touched on what I thought from a Peneth when we started chatting about policy environment. What would make a difference to NewRiver from a new government in 2024? Positive difference, I should add.
Well, what we'd like the government to be focusing on, whether it's whatever the composition of that government looks like, is greater investment into planning to ensure that planning departments are well resourced to support the sort of change that many town centres and indeed city centres require. We would like to see a fundamental reform of business rates, because notwithstanding that there has been some minor reforms that are broadly sort of helpful, we think that the burden on businesses that operate in retail and leisure is too high.
Still too high.
So that's a sort of key area. I do think that I don't want to get too technical here, but I think there needs to be, and I know the government is going to be looking at this as a review of the relationship between landlords and tenants, because it's currently governed by the Landlord and Tenant Act 1954, and today's retail market is fast moving, it's dynamic, and legislation that was passed in 1954 is really not fit for purpose of today.
It's even before you were born, Alan.
Yeah, amazing thing that, isn't it? And then the final area that I think there needs to be a proper grown-up conversation to encourage greater coordination is around how do we decarbonize real estate.
Yeah,
and this is an area that NewRiver is incredibly focused on. We've been working on our ESG strategy for 6 or 7 years. We published our pathway to achieving net zero. So we've got a sort of clear plan. But in retail real estate, it's very different compared to an office building, because the owner of an office building fits it out. So they're responsible for the heating and the lighting system and most of and the fit out, which consumes carbon emissions, depending on the materials you're using, etc. So therefore, they're responsible, but they're going to have to pay for that going forward. In retail real estate, it's different. 90% of our carbon emissions is in the space that we let to our tenants.
Yeah,
and we tend to let the space shell and core.
Yeah,
because all our tenants have different fit outs, different lighting systems, different heating systems. They use different materials in their fit out. Some have refrigeration, some don't. So that's where we got to try and encourage our tenants to become more and more focused around how they're going to decarbonize, the space. And this is where I think the review of that relationship is going to be important, where the government can encourage both owners and occupiers to work in a much more coordinated, effective way. And one of the issues we have at the moment is that actually, I'm not sure a lot of people realize this, but 90% of our emissions is in the space we let to our tenants. Actually, 90% of their emissions is in their supply chain, not in the space they occupy. So we're finding that many of our occupiers are focused around decarbonizing their supply chains, which is incredibly challenging for them. And what we're trying to do is pull their focus back a little bit into the space that they occupy from us. But what's super encouraging, though, Clive, is that I think as it stands at the moment, about 57% of our portfolio is let to occupiers who are publicly committed to achieving net zero. But look, we know we've got a lot more to do. We're on it, and And, we've got a very clear and pragmatic, sensible plan as to how we're...
It's the magnitude and scope or scale of scope 3, isn't it? And that's you're bringing the reality and timescale of that target to life. I mean, I should say, just in terms of planning, if you talk to Stuart Machin about the Michael Gove's decision on Marble Arch, I think you'll get very colourful language, having gone through every process, including a planning inspector report to be turned down for a building that was supposed to be amongst the 1% most sustainable in the whole of London.
Yeah, I mean, look, I was in seeing the property director at Marks & Spencer's, and I think 2 days before that decision had been made. So, they were very hopeful that that would have been approved. So, I can imagine they feel incredibly gutted. So we're probably, all things to a conclusion, Clive. But before we do, I mean, we're sort of like, it's beginning of August, summertime. What are you going to be reading or watching when you're lounging around by the pool or the beach?
I've already done my lounging, but I did read Bob Mortimer's Satsuma novel, which is actually quite funny, and also Tim Marshall's The Future of Geography, which is fascinating, mind-blowing, somewhat depressing about where space is going to take us in the next few years. So, and then I did have other books, but Chianti and Moretti got in the way. So, what about you, Alan?
Well, yeah, I mean, I've got two. One is called Security Analysis. This is a book written by Benjamin Graham, I think about 80, 90 years ago. And it's just been updated. Apparently this is 7th edition, but it's been edited by Seth Klarman, who's like probably one of the top investors consistently for many, many years. In fact, I think he's chief executive of Baupost, and I think he's one of 5 people that Warren Buffett said he'd be prepared to let him manage his own personal money. So I'm really looking forward to getting an insight into that book. And then my other book is more general one, which is The Fourth Turning by Neil Howe. So it looks back in history around the natural cycles, because it's not just about a business cycle. There are natural cycles that go on in terms of politics and demographics and all that sort of thing.
Yeah.
Well, I think we're going to bring it to a conclusion, but thank you, Clive. Really insightful, and absolutely delighted that you're our first guest on the NewRiver podcast. So thanks, Clive.
Thank you.